All right, let's dive in. Today, we're tackling dividend investing. Our listener wants to know how to make it work in this crazy market, and we've got some pretty interesting stuff to look at. We've got a financial news article that's, well, a little bit doom and gloom about traditional dividend stocks. And then, just to mix things up, we've got a video all about ETFs.
Yeah, that contrast is definitely going to be fun to unpack. The article really paints a picture of how those classic dividend stocks, the ones we always thought were safe, are kind of struggling right now.
Yeah. But right off the bat, they talk about how the SPDR S&P Dividend ETF is down 9%.
Yeah.
9% recently, too. But the S&P 500 as a whole, it's actually up a little bit. Not exactly screaming safe haven, is it?
It's a real shift, that's for sure. And the article, it points to rising Treasury bond yields as a big reason why. I mean, think about it. You can get almost 5% on 10-year Treasury bond, right? It's pretty low risk. So compared to that, the average S&P 500 yield, like 1.22%, it just doesn't look as good.
So are investors just getting spooked? Like
Mm.
running to the safety of bonds, even if the return isn't that great?
Yeah, I think you're hitting on something there. It's a change in how investors are feeling, right?
Mm-hmm.
With so much uncertainty in the economy, that guaranteed return from bonds starts to look really, really good. And the article, it goes on to talk about those big tech companies, Apple, Microsoft, all those. They offer dividends, yeah, but even their yields are under 1%.
So even if you're holding on to those big names, you're not exactly swimming in dividend cash. Seems like tech is still all about growth, growth, growth.
Exactly. It's about the stock price going up, not so much about that steady income from dividends.
Okay, but here's where it gets interesting. The article doesn't say to dump dividend investing completely.
Right. It's more about being smart, finding those companies, those sectors that can give you income and growth potential. It's got to be both.
And that's where the video comes in. It highlights this VanEck Energy Income ETF. And get this, it's actually up 10% recently. 10%. And as we head into 2025, it's still going strong. Who would have thought energy would be the hot dividend play?
Well, it actually makes sense when you look closer. This ETF, it focuses on pipeline companies, big ones like Williams Coast, Enbridge, they benefit directly when oil prices go up. And guess what? They tend to offer pretty nice dividends. The average yield for this ETF is 3.2%.
That's way higher than the S&P 500 average. But okay, is this too good to be true? What are the downsides? What do investors need to watch out for when they see these high yields in energy?
You're right to ask that, and it's super important to remember. Energy, it goes up, it goes down, it's cyclical. Is this the peak, or is there more room to grow? That's what investors need to think about, really think about.
So even when the numbers look good, we got to be careful about getting swept up in the hype.
Exactly. Now, the video, it also mentions another ETF, the Amplify Natural Resources Dividend Income ETF. It's doing well, too, because of those oil prices.
Right, and this one seems a bit different. What's the deal with this one?
It's got a wider range of companies in it, like Petrobras, for example. It taps into Brazil's energy market. They're doing pretty well down there. Plus, this ETF, it holds several master limited partnerships, MLPs.
MLPs, okay. Those sound interesting. What are those exactly?
So they're partnerships. You find them a lot in the energy sector. They've got this special tax structure, and they're known for paying high dividends. Like, think Western Midstream Partners. They're a big part of this ETF.
So we've got MLPs, we've got Brazilian energy. This sounds like a pretty diverse ETF. And the yield is even higher, 5.6%. That's almost double the VanEck one. It really shows how important it is to go beyond just the sector and really get into the details of what's inside an ETF.
Oh, absolutely. You got to know what you're buying. Now, before we go all in on energy, let's switch gears for a sec. Remember that news article we were talking about? It actually suggests looking outside the U.S. for dividend opportunities.
Oh, yeah. It said some international dividend ETFs are actually beating the S&P 500. Isn't that a little weird? Wouldn't U.S.-focused stuff be the best bet right now?
Well, see, that's what makes this so interesting. The article, it challenges that whole idea. Maybe, it says, investors are missing out by sticking so close to the U.S.
So where are these hidden gems? What kind of companies are in these international ETFs?
They've got a mix, really. European, Canadian, Asian, big, solid companies, blue chips, like the Wisdom Tree International Hedged Quality Dividend Growth Fund. It holds Novo Nordisk and SAP. Then there's the Invesco S&P International Developed Quality ETF. They've got Novartis and Nestle in there. And the Franklin International Low Volatility High Dividend Index ETF. It's got companies like Bank of Nova Scotia and Japan Tobacco.
Wow, that's a pretty big range of companies and industries. What kind of yields are we talking about with these international ETFs?
It depends. but they're generally pretty competitive. The Wisdom Tree and Invesco ETFs, they both come in at 2.4%. Then the Franklin ETF, it's got a pretty nice yield, 3.5%.
Those are pretty good numbers, especially compared to the S&P 500. Okay, but I'm curious. What are the risks when you start going international? Is it riskier than sticking with U.S. companies?
You're hitting on the right question there. It all comes down to research, right? And knowing how much risk you're comfortable with. International investing, it's got its own things to consider.
Yeah, like currency exchange rates going up and down, politics being unpredictable, different rules in different countries. It's a whole different world.
It definitely adds a layer of complexity, but hey, it also opens up a lot of possibilities. We'll dig deeper into those international opportunities in the next part of our deep dive.
All right, so we've talked about a lot, haven't we? Struggling dividend stocks, those energy ETFs that are doing surprisingly well, and even a little taste of what's happening internationally.
Yeah, there's definitely a lot to think about.
Absolutely. And it really shows you how dividend investing, it's not the same old, it's changing.
It definitely is. But I bet our listeners thinking, okay, that's great, but what does all this mean for me? For my investments?
Exactly. How do you take all this information and actually use it to make smart decisions?
Well, even before you start looking at companies, ETFs, any of that, you got to know yourself. What's your risk tolerance? What are you really trying to achieve with your investments? Are you looking for that steady income stream? Or are you more focused on growing your money over the long haul?
It's like know thyself, right?
Exactly. Once you've got that figured out, then you can start narrowing down your choices. Come up with a plan that fits your situation, your goals, all of that.
So let's say our listeners thinking, those energy ETFs sound pretty good. What's the next step? Just jump in.
Whoa, hold on there. Remember, ETFs, they're bundles of different companies, right? So you got to look deeper. Don't just see energy and think that's all you need to know. You got to see what companies are actually in that ETF.
So it's like a deep dive within a deep dive. Go past that ETF label and really look at the individual companies.
You got it. Like take that VanEck Energy Income ETF we talked about, Williams Co's, Enbridge, 1EOK, all those pipeline companies. We'll do some digging. Look at their financials, their growth prospects, their history of paying dividends. Do they actually fit with how you want to invest?
Okay, so it's all about doing your homework, really understanding what you're buying. But wouldn't that take forever? I mean, how can you realistically research dozens of companies in every ETF you're considering?
That's a good point. It's a balancing act, you know. You want to be thorough, but you don't have unlimited time. You don't need to become a world expert on every single company. Just get a good sense of the major players, the ones that make up a big chunk of the ETF.
So focus on those top holdings, the ones that really drive the ETF's performance.
Yeah, that's a good strategy. And remember, there's tons of information out there to help you. Websites, analyst reports, even those explainer videos like the one you sent. It's all valuable stuff.
Okay, so our listener has done their research, narrowed down their choices, and they're ready to invest. What's the most important thing you tell them?
Diversification. Diversification. You know I love saying that.
That's a classic for a reason. Don't put all your eggs in one basket. Investing 101.
You got it. Even if you're convinced energy is the next big thing, don't put everything you've got into one sector, one ETF, even one company. Spread it around, different industries, different types of assets, even different parts of the world.
Which brings us back to those international ETFs we talked about. Is that a good way to diversify, to get outside of the U.S. market?
It definitely can be. You know, when you go beyond your own country, it can help you manage risk, and you might even find some better returns. But international investing, it comes with its own set of challenges.
Yeah, like we were talking about, currencies, politics, all those things that make it a little trickier.
Exactly. So just like with those energy ETFs, research is key. Understand what you're getting into. Don't just chase those high yields without thinking about the potential downsides.
So it's all about finding that balance, risk and reward, knowing your own comfort level, making smart, informed decisions.
Couldn't have said it better myself. And, you know, there's no magic formula. What works for one person might not work for another. It's about finding the right approach for you, for your specific goals and situation.
It sounds like dividend investing is a lot more complicated than it seems on the surface.
Oh, it is.
Yeah.
But that's part of what makes it so interesting, right? It's not just about picking stocks and hoping for the best. It's about understanding the bigger picture. What's driving the market? What are the trends? And then you can use all that information to make strategic decisions. Research, critical thinking, it's all part of the process.
Speaking of the bigger picture, the article we were looking at, it mentioned something about finding companies with growth potential, even in the dividend world. Why is that so important?
That's a key takeaway. Even if a company has a great dividend, if it's not growing, it might not be a good long-term investment. You want both, right? Solid dividends, but also the chance for your investment to increase in value over time.
So it's like having your cake and eating it too. You get that steady income from the dividends, but you also get the potential for growth.
Exactly. But finding those companies, it's not easy. It takes a lot of analysis, seeing the trends before everyone else, maybe even a little bit of gut feeling.
It's like searching for hidden treasure, right? Finding those companies that are ready to take off before the rest of the world catches on.
That's the exciting part of investing, isn't it? Being curious, being able to adapt, being willing to think differently.
This deep dive has really been eye-opening for me. I'm seeing dividend investing in a whole new light. It's not simple, that's for sure.
And with the market changing so fast, staying up to date, being flexible, that's more important than ever. You can't just stick with what worked in the past.
You got to be open to new ideas, willing to challenge your own assumptions, always looking for those opportunities, wherever they are.
And never forget, investing, it's a lifelong journey. There's always something new to learn, a different way of looking at things, a better way to approach the market.
So true. Okay, let's sum things up for our listener who got us started on this amazing deep dive. What have we learned about dividend investing? Well, it's not dead, but it's definitely changing.
Yeah, you got to look beyond those traditional dividend-paying sectors. Think about growth potential, not just income. Look at companies, even entire markets that other people might be overlooking.
And don't be scared to try new things. Diversify that portfolio, embrace technology. It can really help you as an investor.
And never stop learning. Never stop exploring. Keep pushing yourself to become a better, smarter investor.
That's what it's all about. All right, that's it for this deep dive. But keep those brains working. And happy investing, everyone. We'll be back soon with more investing insights. All right, we're back. And let's talk tech and dividends. It's kind of weird, right? Tech is all about like moving fast, disrupting things. Dividends are, well, they're supposed to be steady and reliable.
It's definitely an interesting combo. But, as tech companies grow up, a lot of them, they start making serious cash.
Yeah.
And then they have to figure out, what do we do with all this money?
Yeah, I mean, they could plow it back into the business, try to grow even more, buy back some of their stock, or they could start paying dividends.
Exactly. For some tech companies, it's like a way to show they're not just this risky startup anymore. They're saying, hey, we're stable, we're profitable, we can give you a nice dividend, and it can actually attract more investors, maybe even bump up their stock price a little.
It's a signal, right? Like they're saying, we've made it.
Yeah, you could say that. And for investors, it's pretty cool. It's a way to get income from a sector that used to be all about growth, nothing else.
But is it risky? I mean, tech changes so fast. What if a company's growth slows down? Or some new competitor comes along? Could they cut their dividend?
That's definitely something to think about. Like with any investment, you got to do your research. Don't just look at the yields, look at the company itself. Is it healthy? Does it have a good future?
Yeah, their position in the market, their new products or services, their leadership team, it all matters.
Absolutely. And it's good to think about tech as a whole too, right? It has these booms where everything's going crazy and then it slows down, sorts itself out.
So even within tech, diversification is still important. Spread the risk.
For sure. Don't put everything in one basket, even if it's a tech basket. Look at different parts of tech. Software, hardware, chips, cloud computing, all that. That way you can capture some of that growth, but also manage the risk a bit.
Wow. This deep dive has been quite a journey. We started with a simple question about dividends, and look where we ended up. Energy, international markets, now tech. It's amazing.
It really shows you how much the investment world is changing, doesn't it? You got to stay on your toes. What worked in the past might not work today.
It's about being open to new ideas, questioning your own assumptions, and always being on the lookout for new opportunities.
And never stop learning. That's the key. The market is always changing. There's always something new to discover, a different angle to consider.
Couldn't have said it better myself. All right, so for our listener who inspired this whole deep dive, here's the takeaway. Dividend investing. It's not dead, but it's definitely not your grandpa's dividend investing anymore.
You got to look beyond the old standbys, those classic dividend-paying companies and sectors. Think about growth potential, not just yield. Think about companies, even whole markets that other people might be missing.
Don't be afraid to step outside your comfort zone, diversify that portfolio, and don't forget about tech. It's changing everything, including how we invest.
And always keep learning, exploring, pushing yourself to become a smarter, more informed investor.
Well said. That wraps up this deep dive. Until next time, keep those brains buzzing and happy investing.